late night, they ain't getting no rest. Work so hard, people think I'm obsessed. Cream at the crop, won't settle for no less. Headed to the top, but needed some focus. Yeah, gorilla of the jungle, I've been beating on my chest. I learned from the struggle, it was all just a test.
Hey guys, welcome back. So today we're going to jump back into things, take a look at kind of the macro side of things, as well as some indicators and metrics we can kind of take a look at to gauge the overall health of the market. So we do have the FOMC meeting today. We had the Bank of Japan meeting yesterday, so we've had some updates and we will get some more clarity kind of regarding the macroeconomic side of things. But we're going to jump into the data here, take a look at what's going on, and then we'll finish on the charts briefly. Not getting too crazy, but we're just going to take a look at kind of what the market are saying heading into this meeting. So without further ado, the first thing I want to talk about is the Bank of Japan's policy decision here. So they have decided to keep their interest rate steady at that 0.5%. So this is good short term. Market's getting a little bit of relief. Not sure if it's optimism around the FOMC meeting or if this is playing a bit of a role in that. We previously recognized some weakness kind of surrounding the initial interest rate hikes that the Bank of Japan had to make. We did talk about that Japan yen carry trade. So as the Bank of Japan continues raising their rates, essentially what you've got is a lot of different investors who have actually borrowed the Japanese yen because of the really low competitive interest rate that it offered as kind of prior to these two rate hikes. It was just near zero interest rates. So a lot of investors essentially borrowing the Japanese yen at 0% interest and then using that money to go and invest in markets, looking to kind of capitalize on some yield there. So as they continue raising their rates, those loans that these investors have taken out are now subject to an increase in interest there. So essentially what they have to do is unwind that trade. So that causes some selling pressure across the currencies and pushes the markets down a little bit. So we were watching that. We did kind of expect another rate hike this meeting kind of. That being said, we will touch on that later. They have said that another rate hike is likely in the forecast, but they haven't really enacted that quite yet. So we see here the move was in line with market expectations ahead of the US FOMC meeting today. The central bank is expected to keep its benchmark interest rate steady. Analysts basically are in the view that the Bank of Japan will soon raise their interest rates again, but split on the timing of the next hike. So that's kind of where I fall into as well. I did expect them to continue raising their interest rates. Maybe next meeting is when we see that raise. They are kind of battling with some rising inflation currently as well. So they will need to kind of respond to that by raising the rates appropriately. So we'll continue to see that, but obviously still a very low interest rate environment compared to like Canada or the United States, where we're looking at about 4 to 4.5% as opposed to their 0.5%. So we do see on Wednesday kept that key policy rate steady, 0.5%, unanimous vote. The export reliant country is now assessing the potential impact of the US trade policies that are being enacted currently. We see basically Japan's economy has recovered moderately according to their policymakers, although some weakness has been seen. So cautioning of the high uncertainty surrounding Japan's economic activity and prices, including evolving situation regarding trade and domestic firms' wage and price setting behavior. So still the tariffs are just in the back of everyone's mind. It's going to play a major role on global trade and therefore the markets as well. So obviously, policymakers recognizing that volatility, that uncertainty, and just taking it slowly, step by step, not making any rash decisions before they get more data and then really can make an informed decision. So we see here they're going to be referring to that reciprocal tariffs and sector-specific tariffs that Trump is expected to announce on April 2nd. So more tariffs likely to come in the next couple weeks, what most people are thinking. We basically see here that an economist at HSBC said they could raise their interest rates in June. So it's a little interesting that we might be looking at a potential rate cut in the US in June, and while the Bank of Japan is actually raising their rates. So kind of that divergence between the two currencies there. Just scrolling down a little bit, we see they basically signaled their readiness to hike rates further. So they did this last meeting. It's why we kind of expected this anyways. So we did, not going to be surprised if they raise their rates again. We actually expect it if inflation continues to move within its projections there. We also see here, just with the trade frictions, these tariffs, one of the Bank of Japan governors here is saying it's really hard to quantify the risk, because essentially what you have is Trump coming out, saying he's going to tariff someone one day and then not the next day, and then they tariff him again the third day. And so basically it's just all this uncertainty, all these headlines, all this volatility, because there's so much uncertainty from all these tariffs and how it's going to affect the global economies. So we do see here Japan not able to get any sort of tariff exemption. I wouldn't expect them to either, just based off of kind of how the tariffs have been utilized around Canada and Mexico. Even then, Canada and Mexico were told that they would be given kind of a reprieve or a bit of a kind of downtime before more tariffs, and then 2 weeks later we just hear that more tariffs are announced. So it's something always in the back of our minds. We need to be aware of it, aware of the volatility that it causes, and then just kind of following the charts, because at the end of the day, that's what's going to tell us which way the markets are going. Essentially, the chart's just a representation of all the investors in the market. So we just look at that. The data will translate onto the charts and tell us what is the most likely move here. So in January, Japan saw a 2-year high inflation rate of 4%. Household spending also beat their expectations in December. So a rise in inflation as well as a rise in spending. So not really surprised to see those two together. Obviously, with higher inflation comes higher costs of goods, and therefore kind of increases the amount of spending that each household needs to do. We see inflation expectations rising moderately. Rice prices are likely to be at high levels, and the effects of the government's measures pushing down inflation will dissipate through 2025. So basically they're saying that despite what the government has done to try and push inflation down, it is trending up, and they are expecting it to continue trending up. The effects of the government really dissipating throughout the next year. And we see revised fourth quarter GDP figures released last week showing their economy grew 2.2% on an annualized basis, slower than initially reported, and it also came in lower than economists' median forecast. So just paying attention to the different economies and how they're growing. I'll flip over here to the GDP now. This is the Atlanta Fed GDP now. So we do see we had basically their estimates here. So looking at a massive drop in GDP estimate here through the Atlanta Fed, we might see it get revised up a little bit, but that is a huge drop from the 2% originally forecasted down to almost minus 3% here, getting back up to minus 2% rate here. So we should see a little bit of relief, a little bit of a revision kind of to a higher target, but shows you that basically the US is expecting to slow down in terms of GDP, and the Bank of Japan is slowing down in terms of GDP. So there are a couple signals out there we need to pay attention to. Flipping over to this, so the big thing today is the FOMC meeting. Likely not going to get any sort of rate cuts or anything like that. The big important thing is going to be Jerome Powell and his language. Is he going to be dovish? Is he going to be hawkish? And how are the markets going to react? So basically, expectations, as I said, set no change in rates. Basically, everyone's just anticipating them to hold their rates. It's exactly what the Fed has been saying they're going to do. They don't have the economic numbers that kind of warrant the need to cut rates continuously, and they do recognize those kind of worrying factors in terms of inflation as well as global escalations in terms of trade wars, tariffs, that kind of thing. So I expect them to stand strong. Maybe we get one rate cut in June. A lot of people are expecting 1 to 2. I'm going to lean towards the 1 for now, just kind of based off of the numbers. If we do get some different economic numbers coming in that support kind of more weakness, maybe the Fed does have to come in, change their stance a little bit, and kind of cut rates a little bit more aggressively than initially planned. But that being said, the data isn't really there to support either direction. So I just expect them to remain in their stance, stand at that kind of benchmark rate, and then look at potentially a cut in June, and then go from there. So basically, we see markets bracing for volatility. It is interesting. We see the dollar up, we see the US 10-year up, and we see the SPY up. So very weird tiered 3 assets to be up together. A lot of it is around the uncertainty. I think a lot of people are kind of bracing for the potential bearish downside in terms of kind of the hawkish version of his language, or they might be looking for some dovish language surrounding the future rate cuts or the ending of quantitative tightening. So either if we see that, you know, obviously some people speculating, hoping that we're going to get bullish news, so the SPY getting a little bit of a bump, and then other people expecting that bearish news, so we see the US 10-year getting a little raise today, as well as the dollar getting a bit of strength. Basically, we'll see that Fed Chair Powell's comments might signal future monetary policy directions, particularly interested in any dovish remarks. So recent economic indicators, including lower than expected CPI and PPI, as well as those GDP estimates, might throw a bit of a wrench in things. I don't really expect, again, he's just going to hold rates kind of where they are. So the best I think we're going to get is either an announcement of the tapering of quantitative tightening, or we're just going to get some dovish language and then kind of just be able to continue hopefully climbing that wall of worry. But we do have some technical levels that we need to take out on the SPY going forward. So we're going to take a look at some recessionary type indicators. So today's all about the macro. We want to figure out what's going on. So I'm looking at a bunch of different charts here. I've showed you guys the treasury yield curve spread right here. So what we're looking at is the 10-year yield curve, the 10-year yield overlaid on the 2-year yield. Essentially when these uninvert, so we see right through here, we have an inversion right in there. And then when it uninverts, we typically get a recession afterwards. So you see right through here we had our inversion, and when we uninverted right here we had a recession materialize. So that's the dot-com, we had the great financial crisis, and we had COVID over here. Although not actually inverting, it did reach that baseline. So right through here we saw this massive inversion in the yield there, essentially marking almost the top of this this rally right through here. Stock market correction. We did now uninvert, so we're in that uninverted territory where typically a recession could materialize, so we need to be aware of that going forward. We can zoom in a little bit further, and we did see, you know, that's still continuing to trend up. So still a worrying factor in my opinion right now. We can also take a look at the 10-year overlaid on the 3-month yield curve, and it'll give us a little bit of a different idea of what's going on. So kind of just a more in-depth little thing here. We saw essentially in this prior recession in 2020, we dipped below, so we inverted, we uninverted initially, and then we kind of curled back over, re-inverted, and then uninverted again. And that's when we actually were in the bulk of that recession that marked the high right there. So we can see pretty much right now we are, you know, we were uninverted, we inverted, we uninverted temporarily, we re-inverted, and then if we do uninvert again, that's going to be another warning signal that we might be looking at the materialization of a recession going forward. But you know, it's not triggered yet, so we need to continue just watching that. There's a few other things. I want to take a look at days after uninversion, because that kind of gives us another little example of kind of the timing surrounding these recessions. So essentially we can kind of see basically right through here on the 10-year and the 3-month, we see this recession about 73 days after uninversion is when that materialized. We saw here basically this recession materialized pretty quickly after that uninversion. Right here we had about, you know, 80 days or about 120 days kind of, so anywhere in that range, you know, before that recession actually materialized. Same thing over here. So you can kind of see basically every single recession didn't trigger initially as soon as it uninverted. We actually had a bit of a delay most of the time, so just paying attention to that right now. If we take a look, zoom in a little bit more, right now we're 47 days after uninversion, so we could continue going up, but we need to watch this as the time goes on and we continue to stay uninverted. It just increases that risk of recession. So like same thing right here. 47 days, or 72 days, sorry, it's kind of hard to find on some of these charts, but basically 56 days right where we saw that kind of initial trigger of that recession. So we're paying attention to that, see what happens. We're going to flip over, take a look at a few more recessionary type indicators here. So this is the SOM rule recession indicator. It is kind of, it gauges the unemployment kind of throughout the country. So we see here when this spikes up like crazy, that essentially signals a recession. recession, so all the way through here. The last one signaling during COVID, massive layoffs kind of causing this insane spike right here. So when we look at the SOM recession rule indicator right now, it's not looking too concerning. You know, the current economic employment numbers are looking pretty decent. You know, despite all the negative revisions, they're holding strong enough for the economy just to continue climbing. That being said, if we start to see this really spike up, it might be another warning signal. We can kind of take a look at a map here, see what's triggered. So probably we'll see number of states 19. So we're looking at, you know, 40% of the country currently with the SOM rule triggered here. So we'll continue following that, see if we get more triggering of that rule. But we'll also take a look here. I want to take a look at the Economic Policy Uncertainty Index. So this is another interesting one. You can also see right when there's tons of economic uncertainty, kind of right around these recession areas. So right through here, right through here. So right now we actually have the same amount of economic uncertainty as we did during COVID. So that's pretty crazy to me. That essentially lined up right with that peak right there. So I need to pay attention to this. We're going to be watching it. But yeah, a lot of people are very unsure about the policy going forward. Not kind of surprising, just with all the different kind of contrasting data that we're getting. So that's when I say, you know, there's a bull case to be made and there's a bear case to be made. The Fed has done a really good job of kind of navigating this environment so far, and I'd like to see it continue. That being said, you know, they're walking a pretty fine line right now, and especially with all this new uncertainty around tariffs, it's just made it a lot harder to navigate this environment. So going forward, you know, we're just taking it day by day, looking at the charts and looking at the data. So taking a look here at consumer sentiment, this is from the United States, Michigan consumer sentiment here. See, consumer sentiment trending down. We're still above 50, so anything below 50 is really kind of a concerning number, but not a good sign to be downtrending here. We got a little bit of relief in through 2024, but back resuming our downtrend. So consumer sentiment in a downtrend. We see the leading economic index here, so that kind of takes in account a bunch of different things like stock prices, housing starts, manufacturing hours, different metrics here. So this is another one we want to see not trending down. Essentially, when it's trending down, that's a signal of kind of weakness, slowing of the economy. So we did, again, get a little bump in 2024, but it's curling over, and it looks like it's heading back down. So we're just going to resume our downtrend for now. We will have to continue following that. Taking a look at US ISM manufacturing PMI. So this is another good metric to kind of get a gauge of the manufacturing side of the economy. So anything over 50 is pretty healthy, and trending up ideally is most bullish. So what we see now, we had our bump in 2024. We've kind of found a bit of a peak for now, trending back down. Let's take a look at the 1 month, see if we can get an idea. Sorry, yeah, so 3 month, yeah, trending up, just trending down. We're still above 50. If we start to lose and go below 50 in terms of the manufacturing PMI, that's going to be another warning signal. Here, we're going to pay attention to the GDP numbers that do come out in the future, but yeah, projecting kind of slowdown in growth. So a lot of different kind of worrying economic factors, in my opinion. We're going to take a look at the stock market really quick here. So essentially, we saw basically opening up green here, coming in, not able to take out this high yet, so we are still in that lower high structure for now, but you do see price is trying to reverse on the low time frame. So essentially what we had our downtrend price action, lower highs, lower lows, and then this is where we found our bottom initially, so right through here. And then you can see on the very low time frame, so this is the hourly, you know, not a lot, you know, we want confirmation on the daily to say the least. So we had one higher high, we had one higher low, but currently we're at this lower high. So what we need to do, take out this high right here, come in, print another subsequent higher low, and then we can go and attack these levels here. So looking at a potential swing trade, potentially in the SPY, you'd be looking at that continued uptrend structure, retest, holding here and supported by our momentum indicators. Also, you'll see kind of this VRVP shelf right through here offering a little bit of support. That being said, lots of resistance that we have talked about. We have this horizontal resistance, we've got upsloping resistance, we've got our 50-day moving average, we've got our 200-day moving average, we've got all the sell order blocks up through here, and the VRVP point of control up here at $600 below the all-time high. So kind of not looking amazing for the SPY in the macro scheme of things. A lot of resistance it needs to take out. Just looking here, this is just that downtrend that I talk about for now, and we are experiencing a bit of a relief bounce, but I think maybe the best case scenario, we go up, we tag our 50-day, maybe our break above our 200-day, maybe we retest the 50-day, but we want to see that curling back up so we can continue this uptrend. For now, though, we have lost major support, and the SPY has a lot of work to do going forward. Take a look at the dollar real quick. Also just trying to bounce here, but it's still that bear flag structure. So basically looks more likely to break down right now. The moving averages continue stacked in kind of a bearish momentum, but we're also seeing quite oversold across our momentum indicators here, signaling we could be due for a bit of a bounce. We take a look at our low time frame, try to get a little better idea. We also see not a little bit more overbought, but still, with the potential to continue up a little bit more. So we do see that we've kind of broken these lower high, lower low structure on the very low time frame, but nothing to write home about right now. It is just the hourly. We're waiting for confirmation on the daily, and the daily chart looks like it's going to likely continue breaking down, but we might see a bit of a relief rally here by the dollar. That would put pressure on our risk assets like the SPY, the NASDAQ, tech stocks, Bitcoin, crypto, that type of thing. So just continue paying attention to that. We see the US 10-year here also kind of just coming in up this trend line, looking good in kind of that uptrend structure, but it's a bit of a bear flag. So on the low time frame, we're looking good. We do see we're holding those lows and highs. Maybe we get a breakout, retest, and continue higher. That's not going to be ideal, but it could be what happens. So we continue watching that. We're watching the SPY. We'll take a look at the NASDAQ quickly. Just coming back into that resistance, rejecting. So we need to continue watching all these. They're coming into these heavy areas of resistance. They need to break them and get higher. Otherwise, we're likely just to continue that downtrend, especially if we get bearish language around the FOMC. We'll take a look at gold. Gold is continuing its run, despite a little bit of weakness today, breaking above 3,000. So gold right now is pretty risky in my opinion. It's still that safe haven asset, but that being said, $3,000 an ounce is pretty expensive in my opinion. I'm not personally interested in adding gold exposure at these levels, and I haven't for a little bit. It's just been this crazy uptrend, so the play for me was buying gold back here on the downtrend breakout. That would have been kind of what you're looking at, not after we've gone on this crazy run and we're sitting above highs. You see these big gaps in support, so if gold does come back, it doesn't look like a big drop in terms of kind of numbers when you're like used to a lot of different assets, but a 2% and a 3% and a 5% drop in gold is a pretty big move for such a large asset. So we do need to keep that in mind. We see oil getting a little bump up here, so not ideal for inflationary pressures if oil starts to go in an uptrend. We see copper doing well, nat gas doing well, uranium doing well. So basically just green across the board, volatility down, TLT down a little bit, and gold down a little bit. So definitely more of a flavor of risk on going right now. So we will see if either this is just going to be in hopes that the Fed comes through with that bullish rhetoric. Otherwise, if we might see if we see more bearish language from them and more of the same that we've gotten over the past couple years, I expect markets to sell off a little bit. So that's why I'm not interested in kind of trading around these events. There's a lot of volatility, a lot of things going on, and we need to kind of be aware of everything and not getting too aggressive when the charts don't support that thesis. So we don't have confirmation of trend. Things are stuck under resistance levels, showing a little bit of weakness, and we've got a lot of macroeconomic uncertainty, so not the time to be taking major positions. But I've said it before, DCAing into your high conviction plays isn't the worst thing to do at different levels. We're 7 to 10% off the top of the SPY. Traditionally a good opportunity to buy. We're 20% off the high in Bitcoin, 25%. Also traditionally a good time to DCA in the bull market, assuming that the top is not in. But we aren't aware of that yet because the charts have not confirmed, so we won't know the top is in until the charts show us. So when I say I'm looking for that bearish breakdown underneath the 5200 day and then continued rejection below it, and then for that sustained downtrend. trend. Otherwise, we could just break out, go in that higher high, higher low structure, get above these moving averages, and continue on another leg. But the market's going to tell us when that is likely to happen. So last thing I want to talk about is basically the current picture that we're looking at. So we see the global money supply has pretty much been mixed since the pandemic. We see the Federal Reserve, the ECB, and others expanded the money supply drastically in 2020, 2021 to counteract those shutdowns. We saw by 2025 tightening monetary policy combating inflation. We see the Fed raising rates from near 0 to 5.25 to 5.5%. And holding rates since. We are now getting a few rate cuts and starting to see a little liquidity flowing back into the system. Global M2 money supply is trending up for now. A lot of people alluding to this, but there are times in Bitcoin's history where global M2 money supply has trended up while Bitcoin continued to go down. The most notable is in our 2021-2022 bear market. So if the top is in and this is likely going into a bear market, it's not the first time that we've seen the global liquidity rising while Bitcoin prices fall. So everyone is expecting Bitcoin price to follow global M2 supply in kind of not in lockstep, but on a lagging basis. That being said, there is instances where it has kind of diverged from that, and we need to be ready for that potential. We see here consumer savings essentially spiked during the pandemic due to the stimulus checks, reduced spending opportunities, and a lot of caution. Basically, by 2025, all of this excess savings has been eroded. In the U.S., household savings rates dropped to 3.5% in 2024, ticked up a little bit to 4.6% in January, but it's still historically low. In Europe and elsewhere, real wage growth is starting to outpace inflation, offering some relief, but savings remain strained for lower income households facing rising fixed costs. So basically we see globally consumers are less cushioned against the shocks as they were in 2021. We're not going to have that same kind of stimulus. So just don't expect it. Don't expect that same level of quantitative easing that we got back then. They really kind of messed up, in my opinion, with that kind of, and they're not going to do it again. So we also see debt levels rising in the U.S. Total household debt hit a record $18.13 trillion by Q4 2024, up 3.6%, driven by credit card balances, auto loans, and mortgages. So mortgages being the most dominant, they're at $12.6 trillion. And we see the credit cards being kind of the fastest growing unsecured debt is in credit cards. So it is kind of a bit of a vulnerability in terms of consumer debt. We see savings not at historical levels, and we see consumer debt levels rising. So now we're going to talk about credit and mortgage delinquencies. So delinquencies creeping up, but remain manageable in the U.S. 3.6% of debt was delinquent in Q4. Auto loans and credit cards showing elevated past due rates. Mortgage delinquencies at 3.2%. They're below pre-pandemic levels thanks to fixed rates and stronger borrowing profiles. But globally, unsecured debt delinquencies such as credit cards are rising faster than secured debt. So interesting to see, basically, with all the rising costs in the world, that everybody kind of have to take on more credit card debt to be able to pay the same amount, or be able to purchase the same amount of goods and services that they needed prior. We also see auto loan delinquencies may stabilize or dip by late 2025 if the economic conditions improve, but riskier borrowers are definitely feeling the squeeze here. So that is something we want to pay attention to. Continued credit and mortgage delinquencies are not good for the overall economy. It just kind of really puts a damper on consumer spending, and then that lowers the profit margins of the companies, lowering growth. So GDP estimates, although GDP is sluggish, ultimately hasn't collapsed yet. But there is that major, we talked about that huge estimate down, that big revision. We'll see if it gets revised higher, but we will continue to follow GDP. Basically, global growth is projected at 2.8 to 3% as per the IMF, tempered by high debt, geopolitical risks, and structural challenges like aging populations and weak productivity. So definitely some things to pay attention to in terms of GDP and growth in terms of both the US and a global side of things. So consumer sentiment, kind of pretty low. We showed you that on this chart previously. So consumer sentiment also dropping, not really ideal. Couple that kind of with the credit card delinquencies as well as the reduced savings. So obviously consumers feeling the effects of this more so than the richer upper class. We see inflations, they're moderate but they're sticky. So the Fed still maintains its standard of 2% in terms of its target inflation rate, currently stuck at approximately 3% or so. They do use lagging data, so it is important to remember that. A lot of people look at trueflation for their information, but it is real-time data versus the Fed's lagging data. So generally, the Fed is always going to be a little bit behind. Also, just general macroeconomic conditions causing uncertainty. So everything surrounding that Bank of Japan carry trade, we see kind of the different economic cracks showing themselves. We see the increase in escalations regarding tariffs and world trade, and it's all painting this kind of picture of uncertainty. Basically, markets just walking a bit of a tightrope here. So basically, I kind of think we're transitioning from crisis mode stimulus to a new normal. Maybe we have higher rates, tighter budgets, and more cautious growth. This might also contribute to like slightly lower returns in the stock market. That being said, the stock market should trend up and to the right over the future, but it might be at a little bit of a slower pace, or we might experience that kind of downturn, recession, get that opportunity to buy into the markets, and then we can continue trending up from there. So basically, hope for stability battles fear of shocks, while central banks walk a tightrope and try to tame inflation without triggering recessions, while governments grapple with high debt and kind of increased world trade escalations there. So lots of different things to take in account. You know, we're either looking at a soft landing scenario, we might have a bit of stagflation, or we might end up in a recession. The best case scenario, I think, is most likely the soft landing. You know, we're able to just not experience too big of a drawdown. Markets can rally mildly, and we can just continue climbing that wall of worry as we previously were. But we're going to wait and see what the Fed has to say today, and then we'll be back tomorrow to update you with everything. And if you like the content, if you learned something new, please share, subscribe, and I'll see you guys in the next one.